Hello, everyone. Thanks for coming out. We're really excited to be here. My name is John Smith. That is my real name. But we're excited to talk to you a little bit about market conditions today and the topic of this conference, which is systems for scalable growth. Before we dive in here, I'll kind of give us an intro. We want to make this a conversation. We talked about, hey, we want this to be applicable to you all. We don't want this just to be platitudes about market and stuff that doesn't matter. And one of my mentors, a person I love, Clayton Christensen, author of The Innovator's Dilemma, he would often talk about how he would get people asking him to come to their business and tell him, what do I need to do? And what he'd say is, I really can't tell you. I don't know your business the way you know it. But what I can tell you is the theories that I've developed and that I've worked on, and you can figure out how to apply it. So hopefully we'll touch on a couple ideas here about scaling systems and growth that, big picture we can talk about and you can apply it. So as I think about this first question of, hey, in this market, how do you balance growth and the cost of that growth and investing in it? There's a framework that comes to mind based on this graph. Imagine, if I had a slide here, but y-axis, low cost, high cost, x-axis, complexity of your business, low to high. Okay, and on this graph, we're going to plot two things. One is an organization that has no systems. Okay, it's all paper, it's over email, do it by hand. And what that line looks like for this organization that has no systems is when it's low complexity, it's a very low cost way to do it. You're not paying those monthly subscription fees, it's great. But as the business becomes more complex, that line starts to rise and it becomes exponential and it becomes way more expensive to have no systems. And the reason that is because tons of direct costs, you're throwing bodies at doing things that could be automated, but there's an indirect cost piece, which is you're not delivering a consistent experience to your customers, your employees, you're losing contracts, you're losing the lead, bunch of costs. Second kind of organization that's plotted on this graph is the exact inverse, one that has all the systems. If there's a monthly subscription fee, you're paying for it, and it just automate everything, especially if it says AI, we're buying it. And for that organization, when you start small and not complex, that's the most expensive way you can do it because you don't have the revenue to absorb those kind of costs. But as you get more and more complex, that line comes down, and there's operating leverage. You can spread that over more things. You don't need to throw more and more bodies at problems. And what I love about being a middle market investor is we meet a ton of companies that are somewhere in the middle of that graph. And there's a point where these two lines intersect, where it becomes more cost effective and smarter to start investing in systems versus just saying, hey, we're bootstrapping this. Let's kind of, just do it by hand over email in Excel. And so, I see a lot of companies that have struggled to get this right and see that the world is changing. They either invest too much up front or not, and they don't start to invest soon enough. And so you can get it wrong either way. Curious from you guys, your perspectives on what you've seen with your companies. You're in an earlier stage of the market. How do you view this problem?
I'll go first. Yeah. So I'm Kat, and I'm a VC, so I love to tell you how to run your business. It's my bread and butter. But to that question, just around managing growth and efficiency, Kickstart, the fund that I'm so lucky to be a partner in, we invest at pre-seed and seed, often the first institutional check in. So very early. Sometimes it's just a pitch deck. So on that quadrant, which we all love a quadrant, the complexity doesn't exist yet. Really what we're working to do is ensure that the right amount of complexity comes in over time. All too often what I see is founders feeling a pressure to be too operational before they even really have a product or a business, So I feel like we're trying to help them manage that complexity at every point along the way.
Interesting. Aaron, what are your thoughts? What do you see?
Yeah, I think one of the common themes between what both of you just said is timing and how important timing can be and how aggressively you pursue growth, how much you spend on it, and at what time that's appropriate. We're growth investors, so we're maybe 2 stages past where Kat is investing and maybe 1 stage before where you are. So these are businesses that have been around for some period of time. They have product and service in the market. They're already growing. They're already generating, fairly significant revenue. And so some of the themes that we see is going back to the timing and some of the mistakes is maybe leaning out a little too far over the skis before things are proven and kind of in place. And, some of nothing I'm going to say here is revolutionary, but some of the classic things around unit economics, unit level economics, margin, contribution margin, there was a period of time where it was growth at all costs, and the capital markets would reward and favor that kind of mentality. And it didn't matter what you were doing, how much you were spending. If you were growing fast, you could do okay, you can continue to raise capital. But at the end of the day, you have to have a fundamental business that has enough margin structure built into it that you get to decide how fast or how slow you're going to grow. And, I think if you're a products business, whether you're direct consumer, whether you're selling through retail or through distribution, really understanding the unit economics around your product, and not just your gross margin, but what does it cost to get that product in market through sales and marketing. If you're a retailer or a business that operates units, unit level economics, four-wall unit economics that say, this is how profitable that unit is on a standalone basis. Here's the payback period for that unit. Like going back to some of the basic principles and saying, we have that nailed before we're going to just dump a bunch of fuel on the fire to try to grow as fast as we possibly can. Those tend to be the companies that kind of stumble and fumble along the way.
Yeah. I hate this environment we're in where money isn't free anymore. I love the free money environment, But as soon as money costs something, you have to have unit economics, It's so much harder. But we have a business. We invest in healthcare. So I'm with a group called Levitt Equity Partners, founded by Mike Levitt, former governor of Utah, Secretary of Health and Human Services, invests exclusively in healthcare. But we had a business that traded on kind of, non-economic figures, a kind of per patient basis, Medicare Advantage providers, so serving seniors. And historically, you look at EBITDA, but these businesses trade at $10,000 to $15,000 per life. That's how you think about the value of one of these businesses. And during 2021, that went to $120,000 a life, 10x, because everyone's thinking this is the next big land grab. We got to get the scale players. And now that's back down to, $5,000, like below we had this huge swing. And when there's a cost of capital, all of a sudden it went from the businesses that were growing the fastest to the ones that are trading $120,000 a life. Several of them now are bankrupt or restructuring, and the mindset is, who's actually making money? Those are the ones that are going to trade at the premium. Mm-hmm. As I think about specific examples, and we can share a couple of companies that have kind of gotten this wrong and lessons learned. I think about a Medicare Advantage plan I looked at about 10 years ago in Florida. It was called Physicians United Plan, ultimately liquidated. It was losing $50 million of EBITDA, but their whole thing was, we're going to grow. But then the environment kind of changed, got one of these cycles. We met with them, trying to make an investment, and we're going through their financials. And we get to this cost center, which is the print center. They're losing $20 million on this print center to print advertisements for Medicare Advantage. And we're like, what is all this? And they're like, well, we have 80,000 members today, but once we get to 220,000 members, this thing is break even. And then we're going to make a ton of money off of this. And it gives us all this flexibility to be creative and get ads out there faster. And I just thought, oh, that's great, but too bad no one's ever going to experience this because you're never going to get there. And we walked out, and this is in 2013, there were iPads that were kind of new all on the walls. We walked past a parking lot of 200 wrapped vehicles with their logo and Physicians United Plan, Explorers, and it was all liquidated. And I just thought, you built this, you wanted to build this gold best-in-class product. I get it, you had this vision. It was a better service that worked for those that used it. And there were good unit economics, but you needed scale for it to work. And they were never going to get there because they weren't thoughtful about how they invested in it.
Marketplaces are the same way, especially if you're trying to build a two-sided marketplace. They take forever to build. It's extremely capital intensive, especially if it's two-sided. Building the product, the platform, getting people on both sides of the marketplace. And you can go down the list of companies that have raised hundreds of millions of dollars and taken 10 years to really start to get to scale. But when they do, they work. It's magic. I mean, they really do scale well and they start printing money. And I think you have to have this mindset of knowing what business model you're pursuing. Is it one that's going to take that long? And if so, you have to have capital partners that have that kind of patience and longevity to support you through several rounds of capital and maybe a decade of development work before it gets there. And in today's market, like that's hard to get, you know, with a market that's constantly changing in terms of capital that's available and what's in, what's out, what's favorable, what's not. That's the tough part about being an entrepreneur is you're trying to run a business and set a strategy and a model and a growth trajectory, in some cases based on capital availability that's a moving target.
Yeah.
And so you can't raise money right now. It's very difficult to raise money if you're a two-sided marketplace. But if you're a B2B SaaS company, that might be a bit easier. So the sectors fluctuate, but I think this idea of, you know, being realistic with how long does it really take your business. There are several businesses that require capital and time and resources before they really get kind of critical mass and scale. Like, we know that. But the days of being able to take several years and 3 rounds of funding and burning a lot of cash, like, those are kind of done. It's very, very difficult to raise capital in those kinds of businesses. So you pretty much have to have a model now where you can get to break even fairly quickly and not have to rely on a lot of rounds of capital, unless you just have some product or business model that is, that nobody can say no to.
Yeah. This question was one that we prepared for, and as I looked across the companies, because it's venture, the companies fail. And the common denominator across all of them was a lack of discipline. I think when capital is abundant and growth, especially in marketplaces, you can see really quick growth. That doesn't mean that it's scalable yet, though. And so that discipline that is required across each of the metrics, as Aaron was saying, just like knowing your numbers and how your business actually works. It's so absurd that we were in a time where that was not the case, but that was something that was happening. And I think it was because money was free. You could throw money in order to grow, and we all kind of lost our minds. So I think both with the founders that I'm lucky to support and also in my own brain, I'm really grateful for these moments that enforce discipline, because in discipline, that's where you create great businesses that can grow over time and do it sustainably.
Yeah. Great thoughts. Any thoughts from successes you've seen from groups that have investments or just other companies out there that have done it really well? What did you learn from them? Although we heard earlier that you don't learn from success, you only learn from failure. So maybe if the answer is nothing, then
I think some of, when I think back on the businesses that are successfully growing and they're doing it in a sustainable and kind of a repeatable way, is that they right-size their business along the way. Yeah. And too often, you find companies investing in growth way before the growth actually shows up. And that manifests itself in team and headcount and people and payroll, and you end up with this kind of corporate overhead fixed cost layer that's not going away, and it consumes a lot of cash. And in some cases, if growth shows up quickly, you grow into that and it's not a big deal. But if it takes a year or 2 years or 3 years, like, you can get upside down pretty fast. Yeah. And so I have found that the businesses that try to match the size of their senior leadership team, executive team, and that corporate kind of G&A for the size of their business today, plus maybe 20%, not plus 100%. And as you guys know, entrepreneurs are eternal optimists, and it's always going to be up and to the right, and it's going to move faster than they always think it's going to be, and it's going to take half as much money as they think it's going to be. That's just the dynamic we deal with. And so I think having your business right-sized and your cost structure right-sized in preparation for growth, but not 2 or 3xing your growth, is like some of our best companies, they've followed that principle.
Yeah, and I'd echo that a bit. The ones that I've been lucky to see succeed, they are optimists, but they know the assumptions that are baked into that optimism, and they're constantly checking those assumptions, right? So there's a hope, but there's also a reality alongside it. And I measure a great executive by how quickly they can identify a constraint, remove that constraint, and then find the next one. And that just requires a deep awareness of your business, a deep awareness of your numbers, and also a sanity check and introspection on what's working, and candidly talking about what isn't, so that you can manage to it.
Yeah. So I think what I'm hearing is the finance people want you to make money. Groundbreaking stuff here. Please don't lose money, and then you'll be.
You heard it here, folks.
You heard it here. Breaking news. No, but no, discipline. It matters, right? The environment's different. There was a time where you could lose money and no one cared. If it's a big idea, we'll throw the money at it. But it's different times.
Yeah, I think another dynamic that we see play out from time to time is. I can't tell you how many businesses we've looked at where they've kind of started a business, built a business, started growing a business, and then they decide, hey, I'm going to raise capital because I want to move faster. It's not just that I want to be bigger, but I have to move faster. And they say, look what we've done, and we haven't even really invested in a sales team, or we haven't spent any money on marketing, and look what we've built, look what we've done. They go out and raise capital, and then immediately just they'll hire 20 salespeople, they'll start spending tens of thousands of dollars a month on marketing. And it's almost like experimenting with capital. Things that they haven't done before, but now capital is available. Oh, I'm going to try this, I'm going to try that. And so they start throwing money at 6 or 7 different things. And so going back to this discipline comment, I think unless you have a track record, a skill set, people on your team that are experts in something, it's okay to experiment a little bit with your sales or marketing or go-to-market, whatever it might be. But that might be 10% of your marketing budget. It shouldn't be 50% of your marketing budget. And that's where money just gets thrown away, wasted. The growth doesn't show up. The numbers don't support another capital raise, and you get yourself upside down.
Yeah. It's interesting because some of the best entrepreneurs that I've seen kind of have a shoot first, then aim mentality. And it's like you throw a bunch of spaghetti against the wall, something's going to stick. And oh my gosh, all of a sudden you've caught lightning in a bottle and it starts growing. But that mentality is not great for managing a business always, because as you get bigger and expenses grow, if you just keep testing stuff without really thinking about, is this working? What's it paying off along the way? Are we measuring this?
Yeah.
You can get in trouble.
And I think that's okay in the very early stages. It's not uncommon for a pre-seed company to go through 3 pivots before they find their thing. It's not good for scaling a business.
Yeah.
We're talking about growth and scalability and systems and process for scale. That doesn't work for scaling. It might get you going down your path, and it's probably not good to do that with other people's money. You can experiment and test and throw 10 things against the wall when it's your money. When it's other people's money, you don't get away with that for very long.
Yeah. So the kind of skill set and orientation ideal for growing a company from 0 to 30 million of revenue might be very different than the one that's getting from 50 to 150 million. Really different. And so I think a common pitfall I see is founders especially have to be aware of that difference in skill set and be adaptable and be willing to build the teams around them to recognize where they're strong, where they're weak.
And I'd say from 0 to 1 is a very different skill set than from 1 to 10 and from 10 to 50, right? Because 0 to 1, you're throwing spaghetti at the wall. You're finding if there's even a there. Do you actually have a business? 1 to 10, you're figuring out what works, what doesn't in terms of processes before you throw money in order to scale, right? That's when growth happens, is when you have something that's repeatable, that's not going to fall apart if you throw money and therefore scale behind it.
Yeah. One last example before we kind of pivot to just market conditions generally. I think about a company we invested in. It's a healthcare app technology, and the founder is brilliant. Personal story that's really inspiring. It's an app that could change healthcare in a lot of ways. I think healthcare is hard to change, but it could be really transformative. But I always think of Steve Jobs when I'm talking with her, where she has this vision of what this app and this technology needs to be, and she doesn't want to compromise on it. And I often feel like I'm like John Scully, the Pepsi guy, coming in and being like, no, I got to make money. But this balance of I don't want to corrupt your vision, but I also want to be around to deliver it to someone. And if you don't have any customers yet, we might not get there and be able to have enough money to get there. So it's this real tension. And I would say if you are looking eventually at partnering with private equity for your business, these are the kind of conversations or venture that you should be having. Is what are you seeing today? How do you see the business changing? And making sure that you're aligned so that you're not surprised by someone coming in and saying, hey, we need to be more disciplined, when your orientation is, what are you talking about right now is the explosive growth phase. We can't be disciplined.
Yeah, I love a visionary founder paired with someone who knows how to time a market and execute. A visionary founder on their own can be so dangerous, but it's magic if they've got someone beside them that can take that vision, know when to time the market alongside it, and then execute accordingly. Vision on its own is wonderful. It inspires us, but does that always create massive businesses? No. I think execution and timing alongside vision, that's the trifecta.
Yeah, there's this, I think he was the CEO of Dollar General. I was at a talk with him once where he said something like, dreamers are plentiful and doers are rare. And you want those executors. It's fancy and exciting to be the dreamer, but there's a lot of us out there. It's the people who actually can get in the weeds and do it that, wow, you hold on to those people.
Yeah.
Any other thoughts on this topic? So we kind of touched on it in terms of where are we in the market. There's been a little bit of a retrenchment, maybe not in terms of deal activity, but definitely in terms of valuations. Where do you think we are? Where do you think we're going? What are you seeing just as this group thinks about, is now a good time to sell or take a partner?
You haven't talked
You
enough.
want me to take that?
Yeah, talk.
All right. So what we see in capital markets, there are certain parts of the markets that really didn't slow down when it came to capital deployment and even valuation reset. Pre-seed, for sure one of those. Seed, maybe to some extent. Series A, a little more so. Series B and C. So the later stage, kind of bigger, growthier companies, we saw a huge pullback in capital availability. We saw a complete reset of valuations to the tune of, in some industries, they're half what they were 3 years ago. And so all of that has led to a decline in deal volume. And it's not that the capital isn't out there. Like the most capital ever raised history of the world was in 2021, and that dry powder overhang is still sitting there. So the capital has to get put to work. We're starting to see deal activity pick up a little bit. The challenge is that so many companies raised really large rounds of capital at really high valuations in 2021, even beginning of 22, that they can't raise on those terms or that pricing right now. And so they're trying to extend runway as long as they possibly can. And whether that's with the money they raised 3 years ago or insider rounds, bridge financings, anything that will punt down the field to where they can try to raise next year, the year after. That's what we're seeing in the larger, later stage, kind of bigger round, bigger type company deals. There's no question valuations reset and deal volume is down. Earlier got sheltered a little bit more. The exit environment, IPO window has been frozen for 2 years now. And everybody says, well, next year it should unthaw. Next year, that's been said for 3 years now. So, we're not super optimistic that it's going to come roaring back. I think it's a very slow, kind of gradual progression. It's going to take 1 or 2 really successful IPOs to open that back up. M&A volume is down a bit, but what's interesting is corporate balance sheets. It's harder for corporations to find growth, and so strategic acquisitions on the M&A side are always interesting to them. We're seeing more of the M&A volume happening with strategic acquirers as opposed to private equity sponsors that when debt was available and debt was cheap, they would use that to buy businesses. Now they can't do that. And so it is an interesting time if you're an entrepreneur and you're thinking about selling your business. I wouldn't be thinking IPO right now. I probably wouldn't be thinking private equity. But if there's a clear 2 or 3 candidates that are larger strategic acquirers, you can be very interesting to them because they want and need growth.
Yeah, and we enter at pre-seed and seed, but most often we're staying with those companies till exit. And the guidance that we give them is like, we're patient capital. Are you patient and also self-aware? And don't let every mark be the thing that defines you, because ultimately it's the exit that defines you. And a flat round is the new up round, and the market's going to change. Just make sure that you always have that long-term in view versus, I want a certain valuation at this round. No, it's about setting the company and your cap table up for success, ultimately for that exit.
Yeah. And as you mentioned, being patient capital, like the personalities and values of your sponsors matter so much. It's easy to just look at, well, what's the highest number, right? But if you end up needing another round of capital a year earlier than you thought, huge difference of having patient capital versus someone who's, we're going to cram you down, and it's going to be really painful for you. We better wrap up here. I think we're at our time. But any final parting thoughts on this discussion in terms of advice to this group of how to manage growth with investment in systems and/or how to navigate?
Yeah, I think my closing comment would be, since this is a growth summit and the topic is about growing, putting systems, people, resources in place for growth. Growth is a great thing. You don't build, equity value without growth, and growth ultimately turns into profitability. So, my advice would be, I think as an entrepreneur and as a CEO, be very realistic on the things that are within your control as it relates to growth and what things are out of your control. And sometimes that takes just a dose of reality, that everyone would love to have their businesses growing, but sometimes, whether it's consumer demand, market demand, conditions, like you're just fighting against the wind. And, in moments like that, there are certain things that you can still control and execute well on with your team and strategy, and some things that no matter how hard you push, you're just not going to change them. You just have to kind of ride through that cycle. And so I think being realistic around what you can control, what you can't, and how that relates to your financial model, your forecast, where you decide to deploy your resources, like be very disciplined and very realistic around your assumptions, your models, stress test them, know the things that you can control are dialed in, and just be aware that there are things you can't. And if the growth doesn't show up for reasons that are outside of your control, don't get so upside down with overspend, cash burn, et cetera, that your company is no longer around.
Yeah. It's football season, so I always worry about companies that, yes, you've got to be efficient, but to the football tie, you've got to be on offense all the time. And if you're thinking in an offensive mindset versus a defensive one, growth is going to come. But efficiency doesn't mean defense. It means stay on offense and do it the right way. And I think that's how great offenses happen, is that you're intentional about every play.
Yeah, love that. And just to close on that same thought, I come back to my graph of the increasing complexity in that line. I've seen just as many mistakes the other way, which is, we invested in a home health business here in Utah that originally it was 3 or 4 states, a couple hundred patients, and all of a sudden they're in 25 states serving thousands of patients. And they leaned heavy, a founder that we partnered with, on just do it on paper, just send an email. And the market was so good that they were still growing 10 to 15% every year, but we realized we are getting over our skis. We're not keeping on track of everything. We brought in a lot of resources and implemented a new electronic medical record system. Got rid of Salesforce that was used poorly and put in HubSpot with some modules that were really helpful for us. And we went from growing 10 to 15% year over year to 300% year over year. And you look back and say, hey, this is a successful company by every measure, but what were we missing because we didn't have those right systems in place? So you can overinvest, underinvest. Just be self-aware and track your company's situation. Is going to change over time, change with the seasons. So appreciate the time from everyone today that we could be here. Appreciate the invite. Thanks for joining us.